Preparing for a regulatory reporting analyst interview. You've reached Candy Mentor, and this video is for you. We'll walk through 15 key questions you're likely to face. For each question, you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. What does a regulatory reporting analyst do in a bank or financial institution? A regulatory reporting analyst translates a firm's financial, risk, and transaction data into returns required by regulators. In a bank, that could include capital, liquidity, leverage, large exposure, or statistical reports. My role is not just populating templates. I validate source data, explain movements, investigate breaks, document controls, and ensure submissions are accurate, complete, and on time. Strong analysts understand both the regulation and the data lineage behind the numbers. While answering, focus on the analyst's role in preparing regulatory returns, validating data, explaining movements, coordinating with stakeholders, meeting deadlines, and supporting compliance with capital, liquidity, and prudential requirements. Question 2. What is the difference between financial reporting and regulatory reporting? Financial reporting is mainly for shareholders, management, auditors, and public disclosure, usually under international financial reporting standards or local generally accepted accounting principles. Regulatory reporting is for supervisors and focuses on prudential safety, capital adequacy, liquidity, leverage, exposures, and systemic risk. I would not assume the general ledger number can be submitted directly. Regulatory reporting often requires specific classifications, risk weights, netting rules, maturity buckets, and regulatory adjustments that differ from accounting presentation. Make sure to cover the audience, purpose, basis of preparation, level of granularity, reporting frequency, and why regulatory reporting often requires adjustments beyond standard accounting numbers. Question 3. How would you ensure the accuracy and completeness of a regulatory return before submission? I start by confirming completeness of source feeds and comparing control totals to the general ledger, risk systems, or trade repositories. Then I perform reconciliations, template validations, reasonableness checks, and period-on-period variance analysis. If a movement looks unusual, I investigate the driver and document the explanation. Before submission, I would ensure maker-checker review, evidence retention, stakeholder sign-off, and timely escalation of material unresolved issues. Accuracy comes from controls, not last-minute inspection. In your answer, talk about source-to-report controls, reconciliations, variance analysis, completeness checks, maker-checker review, sign-offs, documented evidence, and escalation of unresolved breaks before regulatory deadlines. Question 4. Explain CET1, Tier 1 capital, total capital, and the capital adequacy ratio. Capital adequacy measures whether a bank has enough loss-absorbing capital relative to its risk-weighted assets. CET1 is the highest quality capital, mainly common shares and retained earnings after regulatory deductions. Tier 1 includes CET1 plus additional Tier 1 instruments, while total capital adds Tier 2 items, such as eligible subordinated debt. The ratio is capital divided by RWAs. Regulators monitor these ratios because they indicate resilience under stress and constrain excessive balance sheet growth. Be sure to mention capital quality, common equity Tier 1, additional Tier 1, Tier 2 instruments, regulatory deductions, risk-weighted assets, and how capital ratios measure loss-absorbing capacity. Question 5. What are risk-weighted assets, and why are they important in regulatory reporting? Risk-weighted assets convert exposures into a regulatory measure of risk. A government bond, residential mortgage, corporate loan, and trading position may have very different risk weights because their loss profiles differ. RWAs usually cover credit risk, market risk, and operational risk. The higher the RWA, the more capital the bank must hold. As a reporting analyst, I would check exposure classifications, collateral, counterparty type, and model outputs because small mapping errors can materially affect capital ratios. While answering, focus on credit, market, and operational risk. The concept of applying risk weights, standardized versus internal model approaches, and the impact of RWAs on capital ratios. Question 6. How do LCR and NSFR differ from each other? LCR is a short-term liquidity stress measure. It asks whether the bank has enough high-quality liquid assets to survive 30 days of stressed cash outflows. NSFR is longer-term and focuses on funding stability over a one-year horizon. It compares available stable funding to required stable funding based on asset and liability characteristics. In reporting, I would be careful with product classification, maturity, counterparty type, and encumbrance because those attributes drive the ratio. Make sure to cover liquidity coverage ratio, net stable funding ratio, short-term versus structural liquidity risk, high-quality liquid assets, stressed outflows, available stable funding, and required stable funding. Question 7. Walk me through how you would perform variance analysis on a monthly regulatory return. I would first compare the current return against prior month, prior quarter, and budgeted expectations where available. Then I would apply materiality thresholds and focus on large or unusual movements by line item, entity, product, and counterparty. Next, I would trace the driver to balance sheet movement, trade activity, FX, methodology change, or data correction. Good variance analysis should be explainable, evidenced, and consistent with business events, not just a percentage change. In your answer, discuss comparing current versus prior periods, setting materiality thresholds, isolating drivers, linking movements to business activity, validating with source teams, and documenting commentary for review. Question 8. What would you do if an upstream data feed is late or contains errors close to a submission deadline? I would first assess materiality, which schedules are affected, whether the issue changes key ratios, and how much time remains before submission. Then I would contact the data owner, escalate to reporting management, and follow the approved contingency process. If an adjustment is needed, it must be evidenced, reviewed, and clearly documented. I would never make an unsupported manual override just to hit a deadline. If the impact is material, governance and possible regulator communication matter. Be sure to mention deadline management, impact assessment, escalation, use of approved contingency procedures, evidence, stakeholder communication, possible resubmission considerations, and avoiding unsupported manual fixes. Question 9. How would you reconcile regulatory reporting data back to the general ledger? I would begin with GL control totals at entity, account, product, and currency level, then compare them with the regulatory reporting data mart or template output. Differences can arise from regulatory adjustments, consolidation rules, eliminations, product mapping, or timing between ledgers and risk systems. I would categorize breaks, assign ownership, and document whether each item is valid or requires correction. The key is maintaining a clear audit trail from reported line item back to source. While answering, focus on mapping tables, control totals, trial balance agreement, regulatory adjustments, subledger differences, eliminations, manual adjustments, ownership of breaks, and documentation of reconciling items. Question 10. What controls would you expect around a regulatory reporting process? I would expect controls across the full reporting lifecycle. Up front, there should be source data validation, completeness checks, and controlled mapping logic. During preparation, reconciliations, variance analysis, formula checks, and template validation should catch errors. Before submission, there should be maker-checker review, management sign-off, and evidence retention. Manual adjustments need approval and a clear rationale. Strong controls also include access management, change control, issue logs, and post-submission review. Make sure to cover preventive and detective controls, data validation, reconciliations, maker-checker review, change control, access control, sign-off, evidence retention, issue tracking, and governance over manual adjustments. Question 11. How do you handle regulatory changes or new reporting requirements? I would start by reading the rule text and identifying which entities, products, templates, and data fields are affected. Then I would perform a gap analysis against current systems, mappings, controls, and submission timelines. Implementation usually requires coordination with finance, risk, technology, operations, and compliance. I would support testing, document assumptions, update procedures, and run parallel reporting where possible. The goal is not only compliance on day one, but a repeatable, controlled process. In your answer, talk about reading consultation papers or final rules, impact assessment, data gap analysis, implementation planning, UAT, control updates, stakeholder training, and parallel runs before go live. Question 12. What experience or approach do you have with regulatory submission validations, such as XBRL or template validation errors? Validation errors are useful because they show where the return conflicts with taxonomy, arithmetic, or business rules. I would separate technical issues, such as format or tagging, from substantive issues, such as a cross-template inconsistency. Then I would trace the failing cell, check the source data and formula logic, correct the issue if appropriate, and retest. If a validation appears inconsistent with the regulation, I would escalate rather than force a number through. Be sure to mention technical validations, business rule checks, taxonomy requirements, cross-template consistency, resolving error messages, retesting, evidence retention, and knowing when to escalate interpretation issues. Question 13. Explain large exposure reporting and why regulators monitor it. Large exposure reporting helps regulators monitor concentration risk to a single counterparty or group of connected clients. Even a well-capitalized bank can be vulnerable if too much exposure is tied to one borrower, issuer, or economic group. The report typically aggregates exposures, applies eligible credit risk mitigation, and compares the result to regulatory limits based on eligible capital. As an analyst, I would pay close attention to counterparty hierarchy, guarantees, collateral, and connected client mapping. While answering, focus on concentration risk, connected counterparties, eligible capital limits, exposure calculation, credit risk mitigation, aggregation rules, and the importance of identifying breaches early. Question 14. How would you respond to a regulator or auditor asking for support behind a submitted number? I would respond with a clear audit trail, the submitted cell, calculation logic, source extracts, reconciliations, adjustments, approvals, and any relevant procedure references. I would avoid giving a rushed verbal answer without checking evidence. If the number is correct, I would explain it simply and provide support. If I find an error, I would escalate internally, quantify the impact, determine whether resubmission is required, and communicate through the proper governance channel. Make sure to cover audit trail, source system evidence, reconciliations, procedures, approvals, variance explanations, professional communication, ownership, and correcting errors transparently if a genuine issue is found. Question 15. Tell me about a time you had to manage multiple reporting deadlines or stakeholders under pressure. I would structure this as a star example. In a reporting close, competing requests often come from finance, risk, compliance, and senior reviewers. I prioritize based on regulatory deadline, materiality, and dependency, then maintain an issue tracker with owners and timestamps. I communicate early if something is at risk, rather than surprising people late. Under pressure, I still protect core controls, reconciliations, review evidence, and approval. Speed matters, but unsupported reporting creates bigger problems. In your answer, use a structured STAR approach, highlighting prioritization, communication, issue tracking, deadline discipline, stakeholder management, control mindset, and how you protected accuracy despite time pressure. If you are still with us, congratulations. You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.